Hi, this is Ivy. I'll be talking about theory of accounting, the exit price accounting theory. One of the most famous expositions of a normative accounting theory was developed by an Australian researcher, Raymond Chambers, and that is the exit price accounting theory. Chambers labeled his theory as continuously contemporary accounting. This was developed principally between 1955 and 1965. Chambers put forward a view that accounting research and accounting theory should be developed with an underlying objective of providing a better system of accounting, rather than simply describing or explaining contemporary practices. Chambers' work culminated in 1966 with the release of the document entitled Accounting, Evaluation, and Economic Behavior. It relies upon assessments of the exit or selling price of the entity's assets and liabilities, as a consequence being labeled as an exit price accounting theory. The development of this theory was based on a number of key assumptions. First, firms exist to increase the wealth of their owners. Second, successful operations depend on the organization's ability to adapt to changing circumstances. Last but not least, the capacity to adapt will be best reflected by the monetary value of the organization's assets, liabilities, and equities at balance date, where the monetary value is based on the current exit or selling prices of the organization's resources. According to Chambers, a key objective of accounting should be to provide information about an entity's ability to adapt to changing circumstances, or he referred to as an organization's capacity to adapt. Capacity to adapt is directly tied to the cash that could be obtained if an entity sold its assets. Chambers' theory advocated that an entity's balance sheet should be based on the value of all assets on their respective selling prices. If the asset is not readily sellable, it did not contribute to an entity's capacity to adapt to changing circumstances. The profit for a period should also be tied to changes of the current exit prices of the organization's assets. As such, profit as a measure should reflect changes in an organization's capacity to adapt. Chambers proposed that his model of accounting would provide information that would be useful to all financial statement users. His theory of accounting is often referred to as a decision usefulness approach to accounting theory development. Proponents of the decision models approach develop models based on the researcher's own perceptions of what is necessary for efficient decision making. His decision models approach considers the decision-making requirements of financial statements to be the primary reason for developing a particular accounting system. Under this theory, organizations that cannot adapt are considered relatively more likely to fail. The more liquid an organization's assets, the greater was the perceived capacity to adapt. If an organization had very specialized assets, which did not have a secondary market, such an organization would consider it to have very low capacity to adapt. If circumstances changed, an organization with very specialized assets would be more likely to fail. Chambers prescribed that all assets should be recorded at their current cash equivalents. Current cash equivalents were represented by the amount that would be expected to be generated by selling those assets. The net exit prices were to be determined on the basis of an orderly sale. Within this model, the balance sheet should clearly reflect the expected net selling prices of all the entity's assets. The net selling prices would acknowledge any costs that would be incurred in making a sale. Active capital would be represented by the total net selling prices of various assets, less the liabilities of the company. Profit would reflect the change in the organization's capacity to adapt that had occurred since the beginning of the period. According to Chambers, if assets cannot be sold separately for the purpose of determining the organization's financial position, they are deemed to have no value. This is considered too extreme for many accounting practices. Assets such as goodwill or some work in progress would be assessed as having no net selling prices and therefore would be contributed as zero value. Furthermore, it does not consider the value in use of assets. If an asset is retained rather than sold, its value in use is more likely to be greater than its current exit price. This could apply particularly in the case of specialized resources, as it may have a positive value in use, but if it cannot be sold separately, for the purpose of this theory, it has no value. Another criticism of this theory is that in valuing assets at their perceived sale values, there is an implication that the firm intends to liquidate its assets. Obviously, this might not be the case. Nevertheless, Campbell's model does not provide useful information for determining an organization's capacity to adapt, which he argues as a central objective of accounting. His model has also been criticized on the basis that exit prices are determined by the price that could be achieved in an orderly sale. These sales might be different at different times and might not reflect values at balance date, as the values are based on the opinion as to perceived selling prices. It has also been argued that such financial statements might not be useful for monitoring the stewardship of the firm's management.